The Forex market is the largest and most liquid financial market in the world. Millions of traders participate daily, capitalizing on currency fluctuations. Forex stands for foreign exchange, involving the buying and selling of currencies. The market operates 24 hours a day, 5 days a week. This makes it accessible for traders across different time zones. Forex trading has a low barrier to entry and can be started with a small investment. Numerous online brokers offer accessible platforms for trading currencies. However, it comes with its own set of risks. Approach Forex trading with a cautious and informed mindset. Understanding the basics and managing your risk are key to success. Let's delve into the world of Forex and begin your trading journey. Before diving headfirst into Forex trading, it's crucial to grasp the fundamental concepts that drive this dynamic market. At its core, Forex trading involves the simultaneous buying of one currency and selling of another. Currencies are traded in pairs. For instance, the EUR-USD currency pair represents the exchange rate between the euro and the US dollar. When you engage in Forex trading, you aim to profit from the fluctuations in exchange rates. If you believe the euro will strengthen against the US dollar, you would buy the EUR-USD pair. Conversely, if you anticipate a decline in the euro's value, you would sell the pair. Several factors influence exchange rates, including economic indicators, geopolitical events, and market sentiment. Economic indicators such as interest rates, inflation, and gross domestic product growth can significantly impact currency values. Geopolitical events such as elections or policy changes can also introduce volatility into the market. Understanding these fundamental factors is essential for making informed trading decisions. By staying updated on economic news and analyzing market trends, you can gain valuable insights into potential currency movements. For beginners venturing into the Forex market, demo accounts are an invaluable tool. A demo account simulates a live trading environment. It allows you to trade with virtual money, eliminating the risk of financial losses. This provides an excellent opportunity to gain practical experience without putting your capital at stake. With a demo account, you can explore different trading platforms, familiarize yourself with order types, and test various trading strategies. You can experiment with different risk management techniques and learn how to navigate the market's ups and downs. Trading on a demo account helps you gain confidence in your abilities and develop a deeper understanding of market dynamics. You can track your progress, identify areas for improvement, and refine your trading strategies. It's important to approach demo trading with the same seriousness as live trading. This includes setting realistic goals, managing your virtual funds responsibly, and analyzing your trades to learn from your mistakes. Section 4. Navigating the market's strategies and risk management. As you transition from demo trading to live trading, it's essential to have a solid understanding of trading strategies and risk management techniques. Various trading strategies can be employed in the Forex market, each with its own set of rules and principles. One common strategy is trend trading, which involves identifying and capitalizing on established trends in currency movements. Another approach is scalping, which aims to profit from small price fluctuations over short periods. It's crucial to choose a trading strategy that aligns with your risk tolerance, trading style, and financial goals. Risk management is paramount in Forex trading. It involves taking steps to protect your capital from potential losses. One essential risk management technique is setting stop-loss orders, which automatically close your trades at a predetermined price level. This helps limit your losses in case the market moves against your position. Another important aspect of risk management is determining your risk-reward ratio. This ratio outlines the potential profit you aim to achieve relative to the amount of risk you are willing to take on a trade. By carefully assessing your risk appetite and implementing appropriate risk management techniques, you can trade more responsibly and protect your investments. Section 5. The Psychology of Trading, Mastering Your Emotions. Understanding Forex fundamentals and strategies is crucial, but the psychological aspect of trading is often overlooked. Emotions can significantly influence your trading decisions. Fear, greed, and hope can cloud your judgment and lead to irrational behavior. FOMO can lead to impulsive trades without proper analysis. Greed can cause traders to hold on to winning positions too long. Fear can lead to premature exits, preventing potential profits. Develop a disciplined trading mindset. Stick to your plan, manage risk, and don't let emotions dictate decisions. Practice mindfulness to stay calm and focused. Trading is a marathon, not a sprint. Learn from mistakes, stay disciplined, and maintain a long-term perspective.